Let's talk to Tim Gregory. He's an investment manager for Vermeer Investment Management. Very good morning to you, young Tim.
Morning, Nick.
Right, what on earth is going on with this sad Great British Pound? Is this all about Brexit? Is this basically a political trade now, trading our currency?
I think there's two elements to that. Obviously, rates went up last week, and last time I was on the show, I think we talked about the fact that there were no grounds, in my view, for putting rates up based on the current economic environment. And I still think that is the case. However, to be fair to the MPC, I think that was a defensive move to try and put rates up so as to have some firepower in the event there's a no-deal Brexit. And I think the market spotted that immediately. So the sense that the rates went up on Thursday, and an immediate feeling that we were one and done. That was it for rate rises now. And so, there's accompanying sort of fairly dovish remarks that go with that, because the economy is, there is tepid, problems in the high street. I'm sure beer sales did really well during the World Cup, and I'd really like to think that with the pound here and the lovely warm weather we've had, that the tourist season's been really good.
Record
for the economy.
Number of people.
Indeed, so that's really good. So I mean that does help, but it's transient, and we might go back to a more normal summer next year and be utterly miserable, and everyone's trying to escape. So that's one element. But obviously, as you're saying, the Brexit element is clearly coming into play, and nobody really knows whether there is going to be a deal or not. And clearly, Mr. Carney on Friday was trying to warn again of the risks of there being no deal and how that might create uncertainty. And of course, that pushed the pound down again. And I think we're going to be in that phase now until we do know whether or not there will be a deal. I think that is going to be the dominant factor, because I would be surprised now if there were any change to interest rate policy going forward between now and when we know better what is actually going to happen.
Okay, let's talk about the US earnings season, something a little bit sort of more rigid. The Nasdaq closed down 4.25% last week, okay, but it's been a good earnings season, hasn't it? Unless you looked at the FANGs.
Yes, and even the FANGs have been
within
mixed.
The FANGs.
So, Apple, Alphabet, Google, as it is in the FANG, Amazon had great numbers. Netflix, not so much. We talked about that last time I was here. And obviously, Facebook was a very high-profile casualty of the results season. And I think what's been really noticeable, as you say, it's been a good season overall. But, when I look at some of the stocks that we own, if they've had very good results or just good results in life, stocks have tended, particularly those that have performed well, have tended to have a fairly tepid response to that, because, we know that markets have been really good and earnings were expected to be really good. But, of course, the flip side of that is where stocks have disappointed. They have been really high profile. We mentioned Facebook, Twitter, Intel. There's quite a long list of things that where earnings have disappointed, or the outlook statement has disappointed. There's concerns about margin or the revenue outlook. That's been really tough on those stocks. And I think it highlights the fact that the S&P is at a high level already. We haven't quite got to that 2872 level that we got to in January. We've been advocating that we thought it would be difficult to get past that, but we're getting close to it, to be honest. And, there's been some rotation. As I say, Nasdaq was down last week, but the banks have rallied as bond yields have moved back towards 3, and they did have a solid results season.
Yeah.
The results of banks that we looked at, Citigroup, US Bancorp, JP Morgan, they were pretty good generally. And so, there's been a broad rally, and there's definitely been a rally, albeit not particularly, in my view, on great news, in the more defensive staple names. So Procter & Gamble and Colgate, two excellent companies, but struggling with top-line growth, already have very high margins, had results. They were not great, but the stocks managed to hold on to their levels or rally a little bit subsequent to that, which just tells you that the current uncertainty caused by the noise on tariffs and how that's increasing and potentially escalating is making people take a more defensive view of the market right now.
Right. Okay, so if we're the lucky two that go off on the beach for the month of August, come back in September, let's talk about themes for into the year ends. I said to you off air that the more reading I'm doing at the moment, the more confused I am about the state of everything that's going on. in terms of running money and positions, okay,
Yeah.
how can you factor all of this in for sort of Q4?
Well, it's extremely difficult, and we've been trying to run a balanced portfolio, but probably haven't been defensive enough in the last few weeks, and haven't had enough dollar-related earnings because the dollar's been very strong against the pound, and that would really have helped portfolio performance. Have had more time, we're sort of over 40% in dollars, but it's not enough at this time relative to the benchmark. So going into the final quarter, the difficulty is one could rotate the policy of the portfolio to a very, very defensive stance to reflect that
Current thinking.
the current situation escalates into an all-out trade war, and then there's fears of a global recession that follow that. And then, of course, all you do want to own is the defensive, very defensive, stable, staple-type businesses in your portfolio. However, what if we wake up one morning and China and America have successfully negotiated their way around a deal, and cyclical stocks go on a massive tear, recovering all their lost ground, and the staples you bought to give you defensive courage go back to being out of favour, like they were earlier this year. So if you remember earlier this year, the whole theme of the market was we're going to have higher interest rates, bond yields are going to go storming through 3, you need to own banks, you need to own cyclicals, you don't want to be anywhere near staples, and yet here we are, completely right now, with the market able to hold up, but with a rotation to a different area of the market.
But that highlights the fact that consensus is normally wrong, isn't it?
It's not always wrong. It's often wrong. I take that point. But, it is really difficult to know the answer because we just don't know how this trade situation is going to play out. Because we have midterm elections, which are going to be, very important in the US, and you've got to imagine that a lot of what is said between now and those elections will be, politically motivated because obviously everybody wants to win power, come November. So, those are going to be factors that also it's very difficult when you're just trying to concentrate on which companies you want to invest in for the long term. How do I play the current political noise, the noise on trade and all those issues? I could change my entire portfolio and the following morning, I'd made a massive error. And that makes life very difficult day to day. But, so when you have times like this, really, all you can focus on is trying to own very good quality companies for the long term, hoping that you're going to get past these sort of difficult, very noise-driven, short-term periods of time. And it is difficult at the moment, no question.
Tim, on that joyous note, thank you as always. Enjoy August.
Good to see you, Nick. Thanks.